Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, we'll continue talking about corporate finance. And if you remember, I told you corporate finance would include 3 decisions. First one, investment decision, that we already covered in my last 2 episodes. Second one, financing decisions, so capital structure. We're going to talk about this today. And then third decision would be payout decisions, which I'll talk about in my next episodes. But for now, we're going to focus on second question. So capital structure, what is going to be the best way to dividing your company into debt and equity? So this, we may rephrase it in many ways. What can be the optimal leverage? How are you going to raise money? Which is the perfect amount of debt that you can incur? All of this are things that we're going to be studying in this section. And so, what I aim for this episode is that after listening to it, you already know how to identify the optimal financing mix, which is going to tell you how much leverage should a firm have. And so, for doing this, we must first understand that debt is going to have pros and cons. For the pros, of course, we would have more flexibility. If you can borrow more money, that means you can have more extra money for doing more projects. Another benefit of debt may be the tax benefits, because tax, and especially like interests, are going to give you a bit of a tax relief. So this is going to be very good for companies. And the third one is that you may have less agency costs. And I'm going to talk a little bit more on this one because for me it wasn't very intuitive at first, but there are some people who say that having debt is going to make you follow strictly more all of your budget and act, let's say, in a better way because you are not overspending your money. You have someone that's controlling you, in this case, your bank, and it's looking to see it, what you spend, how you spend it. You have to pay interest to them. So it's kind of aligning your interest with the bank interest. So this may be something that some companies might be looking for. But everything is not just benefits. We'll also have some cons. And so, of course, the biggest one would be the possibility of being bankrupt and the costs that this would bring. Because going bankrupt wouldn't just mean that the company disappears, it actually means that it's going to cost you a lot. So we'll talk about this a little bit later in the episode, but going bankrupt would be very dramatic for any company. Second thing is that you may actually have too much monitoring. So something that I was telling you as a pro may actually become a con when it's too much and you can't actually do a lot of things. And this would lead to the third bad thing, and it's a reduced flexibility. So as you can see, that can be both good and bad. And so the optimal financing mix would have to incur in all of these benefits of debt without having too much exposure into the drawbacks. That's where we want to find this optimal level. And so how can we decide how our financial mix is going to go? How much leverage are we going to have and how much equity? We can do it by doing it in 3 different ways. First one will be an industry average. Second one will be the cost of capital approach, so the WACC. And the third one might be the adjusted present value approach. And so I'm going to start talking about each one of these ones. But right now that you can know, there are many methods for knowing actually which is going to be this optimal level. So let's start with first method, industry average. The optimal leverage is going to be the one that brings you closer to the industry average. And this, you may take it as a rule of thumb, you always want to be close to the average. So most people are always wanting to stand out, but as a firm, you're actually safer when you are in the average number. So this is the simplest approach It's very useful, and I think it might be just an easier way for doing your calculations and even for corroborating if the other two methods are aligned. So, some things that you should consider is that some industries are going to present certain generalizations because not all industries have the same amount of debt. So, one caveat here is that you should find comparable companies that are working similar size, similar industry, that are going to be behaving in the most similar way as your firm so you can decide if this industry average is going to be good for you. But so, you will potentially find higher leverage when the tax rates are higher, because as I was telling you, leverage is going to protect you from taxes. Another thing is that you may find higher leverage when the income is stable, because of course here, if income is stable, you don't have as much bankruptcy risk as other companies might have. Also, you're going to have higher leverage when you have more fixed assets. So in construction, you might see lots of this leverage things because they can back up their loans with the physical assets. And so, following that same logic, you're going to find lower leverage when there are more intangibles in your industry. And lastly, lower leverage when your firm is younger, because it's going to be more risky to be bankrupt or to enter on default. So all of this is going to lead you to be careful about these factors when analyzing if the industry that you chose is going to be aligned with what your company is doing. Second method is going to be the cost of capital. And this one basically wants to say that the optimal leverage is the one that minimizes the firm's cost of capital, which is something that we were talking about in my last episode, the WACC. So when you have more debt, you'll replace the expensive equity with cheaper debt, and maybe you might increase the costs of the equity and the debt. So this will have an overall effect on everything in the WACC. But what I was telling you last time is that we don't know in which direction the WACC might go. So if you get more debt, it maybe might increase your WACC or maybe might decrease it. So let's look at all of the factors that are being affected when you have more debt. First, when you have more debt, taxes are going to decrease. Why? Because interest is tax deductible. So this is going to be the first benefit, but it will start changing a little bit your WACC. Second thing, with more debt, your beta will increase because you will relever it with the higher debt to equity ratio, but also because if you think about it, you're becoming a little bit more risky and more volatile. Third, your cost of equity will increase because now, as I was talking about it before, you have a higher beta. And then your cost of debt will also increase. And that's number 4. Because if you borrow more, you will have a higher spread. And so maybe you'll start entering into a higher default risk. And your cost of debt is going to increase. So all of these factors are the ones that you should consider. Plus, of course, the relationship between equity and debt. So as you see, basically everything in the WACC equation is going to change. And there's no rule of thumb for knowing in which direction it will move. You just have to accept it and calculate it every time to see what the actual effect will be. And so the third approach would be the adjusted present value approach, usually abbreviated as the APV. And so this approach is going to say that the optimal leverage is the one that maximizes the overall value of the firm. And this, it's also known as the Modigliani and Miller model because they started developing a model where we had a perfect hypothetical world where capital structure would be irrelevant. And in this model, it had no taxes, no bankruptcy costs, etc., other considerations. A firm would create no value, but it also wouldn't destroy value when it borrows. So technically very simple. And an analogy that you might consider is like taking a pizza. What Modigliani and Miller said that Just the structure would be like cutting. And in this place, there wouldn't be any value created. The allocation is just going to create a different cut. Maybe you might cut 30%, 70%, you might be 50-50. It's just going to determine how the pizza is going to be split, but it's not going to change the overall size of the pizza, of course. But what happens in the real world, which is why they earned a Nobel for this. In the real world, you have all of these factors that are actually going to increase the pizza size or decrease it just by showing where you're cutting it. So if you do 50-50, you may have one side of pizza, then if you do 70-30, and then the pizza might grow larger all of a sudden. So in today's world, with taxes and with bankruptcy costs, we're going to have higher levels of debt being risky, but also incurring in debt being value creating because you're getting a tax relief for having debt. So our optimal, and that's the thing that we'll aim for, is going to be that the marginal expected benefits are going to equal our marginal expected costs of debt. So how do we get to this value? Basically, we have to take an equation in our heads, and it's that the firm value is going to equal the unlevered firm value plus the tax benefits of debt minus the expected bankruptcy costs. So let's look at all of the parts of this equation. First, you would have to estimate the unlevered firm value. In this, how do you do it? First, listening to my previous episode where I explained the unlevered beta. Once you get the unlevered beta, you can estimate the WACC and therefore the firm value. But this is going to be called an unlevered firm value because you're using your unlevered data. Second, you're going to estimate the tax benefits. And so this part is going to be the simplest one of all because you're just going to take the dollar amount of debt that you own and multiply it by the tax rate. So this is going to give you the relief. If it's more debt, it will give you even higher tax relief. But these are going to be the tax benefits that you'll earn as a company. And the only caveat here would be that it depends on every company's constitution, in every country's constitution, where the company's operating, etc. But as a rule of thumb, you could do it kind of easily because in most parts of the world, tax is going to be relieved when you have more debt. So just take the dollar debt value and multiply it by the tax rate. Third, you may have to estimate the expected bankruptcy costs. And so this is going to be a little bit harder because you have to estimate the probability of bankrupt at each level of debt. And then multiply that probability of bankruptcy times the cost of going bankrupt. And so you may have direct costs that are usually between 5 to 10% of the firm value. It's a lot of the direct costs, but you may also have indirect costs. So all of this are going to be the possible bankruptcy costs. And once you have that, the last and final step would be getting to the optimal. So that is equaling the marginal benefits to the marginal costs. In the description, I'm going to leave a link where I'll show you all of these notes so you can follow them while I'm talking about them and also review them later because I know all of these concepts are relatively weird. But hopefully, after listening to this episode, you already have 3 different ways of getting your perfect financing mix. First one is the industry average. The second one is the cost of capital approach. And then the third one is the adjusted present value approach. The easiest one, of course, will be the industry average. The harder one might be the adjusted present value approach. But you can take either of these steps, and it's always going to be useful to do as many calculations as possible so you can decipher which is going to be the optimal financial mix for your company. I'll see you in our next episode.